Hi, everyone. This is Jason Barrick of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest. It is Alex Stanczyk, who is the Chief Market Strategist at Anglo Far East Custodial Company for storing precious metals all over the globe. So thank you for joining us here today, Alex.
Thank you for having me.
Now, Alex, as the Chief Market Strategist for Anglo Far East, what exactly do you do? So, because our listeners might not be familiar with your work.
Well, essentially, the role that I play with our group of companies is I deal mostly with institutional and family office relationships, also affluent clientele of Anglo Far East for our allocated custody services. And I also do a good bit of the research that our company does, as well as the rest of our research team, and really just work primarily with relationships with our institutional partners, our strategic partners, and our clientele.
Okay, and part of the research that you pride yourself on is really digging down and studying, the physical supply-demand fundamentals for physical gold and silver. And what do you think of the coverage by most of the mainstream analysts? You have these guys at Credit Suisse who seem to be routinely wrong. I call them the 1 for 10 hitters. They once in a while they get a call right, but they just seem to have missed a lot of this secular bull market.
Well, sure, there's that. I've noticed that as far as there's different analyst groups, so to speak. You've got the CPM groups, you've got your GFMS type, your World Gold Council type analysts. You've also got your individual analysts throughout the gold market, and then you've got your banks that provide their kind of calls on what's going on. As far as the group of banks, I've noticed two kind of patterns. The first pattern is that they're fairly consistently behind the trend. What they'll do is that it seems to me anyway, they watch for which way the trend is going, and when it's solidly going in a certain direction, they pile into that and say, okay, well, we think it's going this direction. After, of course, it's already going that direction. That's what we tend to notice coming from the banks. The other thing that, and this is speculative on our part, but we think that as far as bullion banks are concerned, it advantages them if they have control of mining supply. This goes all the way back to the original London gold fixing when Rothschild controlled some 70% of worldwide gold mining output. If the banks can get producers to hedge their production and lock in prices at lower prices, they essentially are controlling a substantial portion of what we call the floating supply. So it's important for them to be able to do that. A lot of the miners de-hedged during this bull market, while they were previously hedged for a very long time. Low gold prices, especially prices that are close to the cost of production, are very bad for mining companies. It puts them in a very tight financial position. So if you're a bullion bank and you are able to, so to speak, talk down prices by saying, well, we're projecting it's going to go much, much lower. If you're a mining company, you should probably hedge some of your production. It actually works against the mining companies, it works against investors, and it works to the advantage of bullion banks if they can get them to do it.
Yeah, and Andrew Maguire, who's known throughout the precious metals community, he was talking about earlier in this year and late in the year last year how there was a lot of conferences. The bullion banks would just go there to the miners and tell them, gold's going back to 1,000, silver's going to 15, you guys need to hedge now. But it definitely seems like those guys, as you mentioned, have ulterior motives, because if the miners do panic and hedge, basically now at that point, it was below the production cost. They would have been hedging at a loss. Their shareholders would have been angry, but the banks then could have taken that metal and then sold it into Asia at a nice premium for easy, fast money profits, right?
Yeah, absolutely. But not only that, having control of the floating supply also equals control to some degree over pricing as well. So if you have floating supply available, which you then use to create derivatives on top of, you can keep that game going, so to speak, for as long as you have access to that supply. So the bank's job, if this is indeed happening, I mean, we're not saying by any means this is a foregone conclusion because we don't have a smoking gun to prove it. We're just looking at the market and going, okay, what particular motives would any players have, and what kinds of things might they do under those circumstances. So in that kind of a case, if they're able to control that floating supply by convincing essentially miners that the secular bull market for gold and silver is pretty much over, this thing's going into a bear market, prices are going to be low or down for a prolonged period of time, that would be their objective in order to get them to hedge.
And you think then if the bullion banks ever lost control of the float, as it looks like they're kind of losing control of the float now, you think then that would spell the end of manipulation, or do you think there's other ways then that the manipulation could end?
Well, there's different views on the whole manipulation thing. There are some people in the gold space who think that it's primarily just central banks doing it. I don't know if I agree with that. I think that history shows that central banks have intervened in gold pricing. They also intervene in pretty much everything on a regular day-to-day basis. So from that perspective, I think it's not impossible that they're doing it. I think it would be naive to think that they're not involved in some way or another because they're involved in almost every market today. But I think the overall view that it's some kind of cabal of evil central bankers that are trying to influence pricing, I'm not sure that I'm not convinced anyway. Right now, I mean, this is speaking to your point about the influence over the float. I think bullion banks do what they do to make profits. I think bankers, they don't really have any particular loyalty to any particular central bank or any particular country. I think that they pile into trades or create momentum in trades, whether it's going down or up, if it benefits them, if they're going to make more profit. I think that if there are central banks that are interested in trying to influence the price, for example, the Fed or maybe even PBOC, I think any particular bullion bank would work for both of them and perhaps even at the same time playing one off against the other if it's going to make them more money. I don't think they have any particular loyalties. So this idea that all of the banks are essentially controlled by central banks, I don't know that that's so correct.
So you think then that because it appeared to me, in 2000, I've been in the gold and silver market since around 2007, researching it, and then starting to buy physical metal in 2008 and mining stocks. So I've been following things pretty closely since then, and really, it seemed to me that things just got crazier in terms of the technical patterns on the charts, the same downward price movements after 2011. Do you think the People's Bank of China, that China was involved in knocking the paper price down so they could accumulate more physical metal?
Yeah, I think it's certainly possible. I've written about that in the past, actually, and that mathematically it makes sense that they would actually profit a great deal by doing that. If they're able to knock the price down in the paper market and then buy the physical on the other side of it, if you look at how many ounces they've bought in 2013 and they get an average savings of, say, $60 an ounce from being able to knock the price down in the paper market, how much it costs them to push the paper price down is far smaller than what they're saving on the actual physical side when they're buying it, if you look at how much volume they've bought. So that's certainly a possibility. We don't have any proof, so we don't know for a fact, but they could be one of the players involved in that. Another part of that could simply be that there was speculative momentum in the West where traders were just basically getting out of the trade. And for various reasons in the West, the psychology went negative, sentiment towards gold. I think the bullion banks probably recognized that. I think they increased the momentum in those areas because if they can arbitrage essentially a falling gold price and then go net long GLD shares, turn those shares into GLD, get the physical gold, sell it at a premium to China, the bullion banks are making money hand over fist in this trade, and the people who are losing essentially are the speculators.
Those are interesting points, and the retail crowd, even if you have the required amount of GLD shares, from what I've heard, and I have a friend of a friend who tried to redeem a good amount of GLD shares. If you've heard of Dave Collum on Twitter there, he knows a fund manager who tried to redeem, I think, $60 million worth of GLD shares for physical metal, and he was denied. And I've heard other stories from fund managers like Grant Williams and people like that who have tried to redeem GLD too. So it's just very interesting about, on the supply side for the physical, how much physical China is soaking up in terms of demand.
Sure. The point about being able to redeem GLD shares, it's important to understand that if you read the prospectus, you're not really allowed to redeem GLD shares. It's right there in the prospectus. It's not a mystery. There's a lot of commentators in the gold space that make a big deal about it, but the truth is you never could redeem them. I mean, it says so right there in how the GLD operates. You have to be what's called an authorized participant. And if you read the definition of an authorized participant, it's basically a big bank who trades on the London market, who holds unallocated accounts with the custodian, which is HSBC. So if you read between the lines there and you understand the professional bullion market, the good delivery market, you also understand that really you have to basically be a bullion bank in order to either add gold or take gold out of GLD. You can't do it as a shareholder trading in the secondary market. You're just not allowed to. So that part doesn't surprise me at all. But the other part that you mentioned, as far as that supply going to China, if you think of it like this, the only thing that pushed the price down in 2013 was the disgorging of shares out of GLD and some of the other ETFs, because China's demand increased so much that if you add that to the demand out of India, and you add in the fact that China produced over 400 tons, I think it was like 428 tons in 2013. If you add those three things together, it's almost equal to global mining supply. So, I mean, if you think about that, the only reason the price went down is because of disgorging gold out of GLD. So it's completely based upon Western speculative sentiment. Everybody that's left in GLD right now are probably more long-term holders. All of the hedge funds, all the speculative players that were using GLD for the trade who got out of it, which reflected the amount of tonnage that came out, that's all basically a swing trade in Western sentiment towards gold. So at the point that sentiment changes, and something that I've been watching very closely is GLD inventory, when GLD starts to add back and that demand is combined with what is the demand out of China and India right now, I don't see any other way for gold to go than up. And in fact, here's the other point is that if GLD just stayed the same, in other words, they would have to continue to disgorge another 500 plus tons this year in order to push the price down, assuming China and India demand just stayed the same. So if GLD just didn't move, but China and India demand stayed the same, I think that's going to push the price up. If GLD reverses and starts to add inventory plus China and India demand, I think that's going to really push the price up. And I think if China continues on the same trajectory it did in 2013, which is to add about 40% more demand, I mean, we're looking at a massive potential squeeze in what's called the floating supply, and that's not the overall above ground stock, but the floating supply is what's really critically important to watch in terms of what's going to affect the price.
Those are very interesting points, and we had Kuz Jansen on, if you're familiar with his work of In Gold We Trust, and he said that China, the Shanghai Gold Exchange, imported, I believe, over 2,000 tons of physical metal in 2013, and so far in 2014, in only the first month, he said that the Shanghai Gold Exchange has had 250 tons of physical gold delivered. So obviously, like, there's not a lot of gold that's in weak hands anymore after the paper price correction. So it'll be very interesting to see where the supply comes, because we were at a point, when the gold price went down to $1,180, that the miners they were losing, a lot of them, enormous money on their gold, and the silver miners at 18 were losing enormous amount of money on their physical silver mining. And the question was then, how long were these guys going to be able to survive at those prices or lower? And, eventually the price has to reflect reality, which is supply and demand. And I don't know if the paper price, when it was down at those levels, reflected. I think it was mostly speculator sentiment, like you said, pushing a momentum trade. But the miners were just getting thrown every which way, and just, it was not sustainable, in my opinion.
Sure, and I totally agree with that. I think the really key thing to watch right now is Western sentiment, and watch what the Western speculator is going to do. Because if they start piling back into GLD, it's like you said, I don't know where the gold's going to come from. Because most of the people, I think, who were trading it during 2013, which is one of the worst years for gold in something like 30 years, the sentiment was so incredibly horrible that I heard one, I think it was Jim Rickards that said there was a CNBC guy who said in December you couldn't find a single gold bull anywhere, which isn't true, of course, but it just gives you an idea of how...
On CNBC or Bloomberg you couldn't.
Yeah, right.
Not without them laughing at you in the first minute or two, right?
Right.
Calling you a moron or something.
Precisely. But it just goes to show you how hated gold was as an asset class. So the only people that were still holding it at that point are either extreme contrarians or essentially people who aren't in it for the speculative trade. And what that tells us is that when the Western sentiment reverses, that demand for physical is going to kick back in, and they're going to be fighting, literally, GLD is going to be fighting for supply against China and India in order to get what's available. And obviously as the price rises, there are going to be more people willing to sell, so more supply will become available. But it's going to be completely contingent upon people's long-term views of what's happening.
Now, you recently went on a trip to the Swiss refiners, and the whole gold community was talking about you. I think you went with Jim Rickards. Could you please tell our listeners a little bit about that trip? Because I think it's important to show just how tight the real supply-demand fundamentals are, because the refiners, right, they're right in the middle of the market. They're midstream, so they deal with the wholesalers, and they deal with the exchanges, and then they get the dore bars and the scrap, right? So they're right in the middle of supply and demand.
Sure. I think the refiners are probably the best gauge to determine what's actually happening with physical supply and demand, and in particular the Swiss refiners. In Switzerland, the Swiss refiners, I believe 80% of gold refining in the world is done by 6 of the largest LBMA refineries globally. Now, 4 of those are in Switzerland, to give you an idea how much flow actually moves through Switzerland. And around Anglo-Far East, we kind of liken it, we use the analogy of it's kind of like a river. If you think of physical gold flows around the world like a river, you have various different tributaries that add to the river. You've got mining supply, you've got recycling supply, etc. Sometimes rivers pop up out of nowhere like GLD disgorging tonnage. But at the end of the day, the deepest part of the river where it's always flowing is these Swiss refineries. They're what we consider to be the core of the industry. And there's analysts that track all kinds of data from import to export flows, etc. But we think that the guys on the ground, see, to us, analysts are kind of like guys who are standing on the bottom of the mountain who are commenting about the climbers who are climbing the mountain. The climbers would be the Swiss refineries. They're actually on the mountain, involved in it every single day, and they know from firsthand experience where things are coming from and where they're going, where the analysts are basically just watching what the miners or climbers are doing and commenting with their opinion about what's happening. So that's why when we look for credible information about what's happening in the physical supply, we take what the Swiss refineries have to say very seriously. So that being said, once a year, Anglo-Far East goes over to Switzerland, and we do site inspections of our gold inventories, both for our private allocated clients, but as well as for the institutions that we serve. One of those institutions is the Physical Gold Fund, and Jim Rickards is an advisor, sits on the advisory board for that fund. So he accompanied us on this trip. And we went over, and the purpose was twofold. Number one, we wanted to do a site inspection of the physical gold inventories, but also we like to stop by the Swiss refineries and chat with them to just maintain, obviously, our relationships and also to get their views on what's happening.
And I believe part of the trip, part of the conversation with one of these Swiss refiners, and you didn't speak with one of the tiny refiners, you spoke with one of the largest refiners at length, right? And one of the things that was mentioned was that these guys are running the refinery, right, 24/7, 24/7, 365, and during 2013, they couldn't source physical gold for a certain amount of time, right? And that was the first time ever in the history that they couldn't source any physical metal.
Yeah, that's about correct. We spoke with one of the directors of what I think is the largest refinery. If it's not the largest, it's one of the top two in the entire world. This gentleman has been in the industry for 37 years. He's seen the last bull market in gold through the late 70s into 1980, so he knows what gold flows look like even during major panic buying situations. And the one thing that he said, we talked to him for about 2 hours, and one of the things that he said to me that I found extremely interesting was that he said that there were various times throughout 2013 where he was having a hard time sourcing physical supply. And that kind of a comment has never come out of this gentleman's mouth before. Anglifar, he says, never had a problem sourcing metal, whether that be silver or gold. I know there are, and this is a point of contention for me because there are a lot of people in the gold space who will bang the table and say, oh, there's a shortage of this, there's a shortage of that. But what they're really talking about is a physical fabrication bottleneck, not an actual physical shortage of the metal. And when this gentleman said that, it shocked me because I've never heard anything like that before. I stopped him and I asked him again. I said, wait a minute, you're trying to tell me you're having trouble sourcing the metal, the actual metal. I asked him, when was the last time this happened? And he goes, this has never happened.
Yeah, I had heard that there had been problems getting 400-ounce bars and things like that, certain types of supply. But, or it would take longer to fill like an order that was 7, 8, 9, or whatever figures, depending upon the size of the order. If there was a whole bunch of 7-figure orders that came in at once for a wholesaler or something like that, that would be tougher to fill, or an even larger order than that. But, yeah, I never heard that before about the Swiss refiners, so that's why I think it was important to inform our listeners about that. And that's actually how I found out that article, and I was like, oh, wow, and then I started looking more into your work. I was like, this guy's really on the pulse of supply and demand. Now, in terms of supply and demand, the other part is India. Do you think all these political rules that the Indian Central Bank and the Indian government have put on import taxes, all this stuff, do you think that's really stopping physical gold demand in India?
That's a really good question. And before I get to it, let me back up really quick because you mentioned an interesting thing that I want to highlight, and that is that you said something about when there's 7-figure orders, et cetera, sometimes there's difficulty. I want to emphasize that this particular refinery, it deals with the largest bullion banks in the world. So when it gets orders, we're talking 9 figures, not 7 figures. So it deals regularly with these kind of orders, and that's the kind of magnitude of size that this refinery deals in. And when it's having those kind of issues, and it also, I mean, when you understand where it's sourcing supply, it's doing it from many different sources. It's some of the largest mines in the world ship to this refinery. It does obviously a large amount of scrap, and a huge amount of what was coming out of the ETFs from London being shipped into Switzerland was being re-refined into 4/9 fine kilobars, which are then being shipped off to China. So the sources that this refinery is looking at is pretty much all over the world and from various different sources. So
and you said, sorry to interrupt you, and you said that they were running, I think you said in the article too, that they were running 24/7, 365, right? And they still couldn't meet demand for the kilobars, right? So
yeah, that's correct. To address your question about India, I just saw in a very interesting article today, which was saying that the import demand into India was over 925 tons. I think it was closer to, if my memory serves, not closer to 975 tons, which was actually higher in 2013 with the tariffs than it was in 2012. So even though I've seen premiums in India on an intraday basis up to several $100s per ounce, it hasn't slowed down gold going into India at all. And so maybe just a tiny bit. I wonder what it would be at if there was no tariffs, but essentially smuggling has taken the place of regular illegal shipments, and the demand is still there.
Yeah, it's put a lot of Indians, who abide by the government's laws there in the gold trade, has put a lot of them out of work. But it really hasn't stopped the smuggling either, in my opinion, because I've read some of the funny stories about the smuggling, all the crazy things that people have tried to do to bring the gold in, from Pakistan or Dubai, how people everyone on a plane going to India from Dubai has an enormous amount of gold with them, smuggled one way or another. So it's just pretty crazy, people getting around these laws that the governments and central banks are putting in place to try and, stop demand.
Mm-hmm.
Now, let's talk about multi-jurisdictional diversification here, because this is something important that most people who own physical gold and silver and our consulting clients, we try to explain to them that, you don't want to put all your physical gold or silver in one place. You don't want to store it at home, all on yourself at home, hidden, or you don't want to put in a safety deposit box, or you don't want to just bet on Hong Kong or Switzerland or any one of these things, because I don't know about you, Alex, but governments seem to me to be changing the rules all the time. And it's not just for gold. It's Bitcoin, it's taxes, it's, income, it's all these silly rules and regulations in a lot of aspects. They're desperate for revenue, a lot, especially the developed world. And it just seems to me that they're going to keep changing the rules going forward. And maybe, 30 years ago, Switzerland was the place to store all your physical gold, but I can't really say that that's true anymore.
Well, we really advocate multi-jurisdictional diversification, and what that means to us is some people look at diversification and they go, okay, well, I'm diversified across asset classes, so I'm safe. And our view is that, well, if it's all within one jurisdiction, maybe it's not that safe, especially under situations where there's fiscal dangers for any particular government or jurisdiction. And there's two parts of this. If you look back through history, government defaults, governments having fiscal problems, there's nothing new with that. That's happened many, many, many times throughout thousands of years of human history. The process that it goes through is often very similar, and the results are often very similar. The policy decisions are often very similar. Typically, and if you really want to get a good look at what governments do when their economies and their currencies are collapsing, just look at Venezuela. It's almost a textbook replay of failed policies in the past, where governments will obviously, when governments get into huge amounts of debt, their tax base is crumbling, they're unable to pay for all of the incredible programs that they have, et cetera. Then they start getting ever more aggressive on taxation. As the economy continues to crumble, eventually what they start to do is they start to implement currency controls. The currency controls fail, they start to implement pricing controls. Pricing controls fail, and ultimately the currency starts moving into hyperinflation. Now, I'm not saying that is a foregone conclusion for the United States or any other Western economy. What I'm saying is that gold, in our view, in a portfolio, acts as insurance. It acts as insurance more so than an investment. We consider gold money. If you doubt that that's true, just look at what central banks do. They hold gold. They don't hold coffee. They don't hold sugar. So it's not a commodity. It's money. And it's the central bank plan B. If currencies fail, they rely upon the gold basically to reset the currency system. So they look at it as money and insurance, a plan B. We look at it the same way. If you have a portfolio, you buy fire insurance for your house, not because you want the house to burn down or that you even expect it to. You buy it because you've made a substantial investment in that house and you don't want to lose it all if something catastrophic happens. So to us, gold serves the exact same role in a portfolio. You buy it as insurance to protect the rest of your portfolio in case something strange happens in an economy or in a jurisdiction. Now, we've learned these principles from our own clients. We have clients who are generationally wealthy. What I mean by that is they pass it on from generation to generation to generation. It's not first-time wealth, which is the case for many new rich, essentially. And they don't think in terms of how do I pass this on generationally. But when you have to think in terms of 100 years, 150 years, almost inevitably over that span of time, there's usually some kind of conflict, war, economic collapse, change in government regime in a particular jurisdiction. And if you have all of your assets in that particular jurisdiction during that transition, you stand a good chance of losing a substantial portion, if not all of that. And we know that, again, from not conjecture, not theory, but the real-life experience of clients we have had and have who have had to leave jurisdictions under duress because of whatever situation was happening. But because they had wealth stored in other places, they were able to just pretty much pick up the pieces and carry on, whereas others who did not diversify internationally ended up losing sometimes everything they had.
Now, we're starting to see precious metals vaults. You know, they used to be in Switzerland, they used to be in London and New York, and in more of the developed countries because there was rule of law there, and people trusted the government's taxes used to be low. But the last, 5 years, it seems like a lot of vault space now is being built in Hong Kong and Singapore, and we've seen, I don't know if you've heard about this, but Jim Sinclair and other people in the gold community have had friends who have had allocated accounts in Switzerland or other Western investment banks like ABN AMRO and stuff, and these banks have taken their gold and stuff like that. So do you think this is why then that the vault space is moving to Asia and out of the Western banking system?
Well, we see a couple of different trends here. Number one, in speaking to the Asia situation, I think the vaulting that's being built over there really is for Asian demand, because the demand over there is absolutely huge. So just to serve their own populations, that's why they're building those vaults over there. As far as Switzerland is concerned, we look at, if you want to look at different kind of jurisdictions to store in, there's a lot of newsletter writers and people in the gold space who are heavily advocating Singapore and Hong Kong. While we don't disagree that it's wise to diversify the locations where you're storing, if we had to pick the strongest jurisdiction for physical storage, we still think Switzerland is the best. And the reasons for that are very few people in the gold space consider that gold is actually a strategic asset of importance to national security. Because in sovereign conflict, paper money really ceases to be used. In other words, sovereigns aren't trading their paper money with each other when there's war. They rely on gold. Gold becomes money again de facto during wartime. So, in other words, the way we look at it is if there is some kind of strategic conflict, for example, and ends up breaking out between China and the United States, Hong Kong is only a step away from China. Singapore is only a step away from China. And in particular, both those locations I don't think stand very much chance of stopping China from just walking in and taking it. Switzerland, on the other hand, is the last place on earth that I would want to try and invade militarily. There's a reason that Switzerland's maintained its neutrality through hundreds of years and several world wars. And there's a reason why it doesn't get invaded very often. There's a very good book written by John McPhee, La Place de la Concorde, I believe is the name of it, or something very close to that. I can get the actual name for you later. But I highly recommend reading it because it tells you something about the Swiss military tradition. It tells you something about how the Swiss defend their country. And I think aside from dropping nukes on Switzerland, it's the last place that you would be able to go in there with a military force and take the gold. Now, that's aside, of course, from what's happened with the banks, et cetera, over there. It's important to understand that gold held outside of the banks and stored in private vaults falls under private property, not banking law, which is regulated at the federal level, which is a really important thing to understand when looking at Switzerland as a storage jurisdiction.
So no UBS or no Credit Suisse. You're talking about a regular private vault like a Brinks or some other type of company then?
Well, what Anglo Far East does is that we use Viamat. We don't use Brinks. We don't use Group 4 Securicor. These are some of the largest security companies in the world. We prefer Viamat because they're a privately owned Swiss company. They're one of the largest security, vaulting, and transport logistics companies in the world. And we are actually, speaking to that trend you were talking about, there's a substantial number of people who are taking their gold out of the bank's custody and moving it into facilities like ours and into custody arrangements like what we do.
Yeah, and that makes sense because, I mean, you've had I don't know if you saw the Morgan Stanley lawsuit in the last couple of years. Morgan Stanley was overcharging for many millions of dollars in fees for allocated accounts for gold and silver, and they didn't have the metal. So, and I'm sure they're not the only one, right? Because you have examples of ABN AMRO and others, investment banks that have done a lot of the same stuff. So I'm sure people are getting fed up with this type of behavior from the banks, because maybe the banks sold the physical metal even though they're not supposed to. They did this at MF Global too. They took physical metal. So it's just really interesting that all the changes that have been going on in the gold market, and it's very difficult for a buy and hold investor to trust their physical metal in the normal places that they used to be stored in the past.
Sure, and that's completely understandable, and it's something that every owner of gold and silver has to take into consideration, and they have to make their own decisions as the best way to do it. Some people think that the best way to do it is to store it themselves, which we actually advocate. Our just kind of as a guideline, we suggest to people, if they've never bought gold and silver before, to calculate 3 months worth of living expenses, whatever that's valued at, and then buy that much gold and silver and put it someplace safe where you can actually reach it, because that's essentially money of last resort. In the worst case scenario, you could use that if you had to travel, if you had to, whatever you had to use it for. And I'm not suggesting that we foresee those kind of scenarios playing out, because we think they're very low probability. But it doesn't hurt to have that as an insurance. But then once you start to get into substantial quantities, we're talking in the hundreds of thousands or the millions, you then have other considerations, whereas you may not want to vault it in your house. You may not want to, unless you're going to have security guards standing around in Class 3 body armor with assault rifles, et cetera, at your house. It's not, plus you have to consider insurance. How much does it cost to insure that? Do you want to make your house a potential target for thieves? And then finally, how you liquidate it later. These are all really important considerations. So for gold and silver owners who hold substantial amounts, we recommend spreading that out both from a jurisdictional standpoint as well as from a vaulting standpoint. Try to keep it outside banks if at all possible, especially because of all the new regulations that are being passed with bail-in terminology, which essentially means that if there's a liquidity crisis and a particular bank fails, any assets that you have with the bank, they're considering that confiscatable. Essentially, you're considered an investor with the bank, and your assets can be taken to recapitalize those banks, and that's happening worldwide. So it's something to consider as well when deciding where you're going to store your metal.
It's a very important point, Alex. Now, I have one final question before I let you go. It's a big picture. Do you think the same dollar as a world reserve currency in the petrodollar, do you think we're going to see the status quo, and then do you think things are going to stay the same 10 years from now, or do you think gold is going to play a larger role in the world monetary system going forward?
Well, I don't think it's possible for things to stay the same. I think the Western central banks in particular have been trying to keep it the same for as long as possible, but the bottom line is that the world is changing. If you look at the shift from the British pound to the U.S. dollar, that process took about 5 decades. So depending upon where you start to measure it from, if you look at it, start measuring from 1971, which is when Nixon severed convertibility to the dollar, closed the gold window. I mean, we're 44, 45 years into that process. So that's getting pretty close right there if you use that as a measuring stick. I do think that the next system is going to have some kind of gold component to it. I don't know what it's going to look like yet, but I think if you watch what's happening over in Saudi, for example, which is the main pillar of the petrodollar, I think that's a very important thing to keep an eye on, is the Saudi-U.S. relationship. If that relationship continues to fail, it creates a potential situation where the Saudis will step away from the U.S. dollar. Should that happen, it will only accelerate, I think, the demise of the U.S. dollar as a reserve currency. Not that I think it's going to go away anytime soon. I'm not suggesting that. But I do think that other alternatives are probably going to be put into place in the next 5 and 10 years.
Yeah, I would agree with that. It's really tough to say which plan or system is in place now, because I follow Jim Rickards' work really closely. I've read Currency Wars. I'm sure you have as well, since you know Jim. But and I'm hoping I think we're going to have him on for a podcast in April, so hopefully I'll be able to ask him more about that. But it's obviously these plans are in flux, and whoever was an ally in the past may not be an ally going forward because China and Japan have hated each other for a long, long time, and then they were trading partners, very good ones for the last couple decades, and now it looks like they're back to hating each other again. So things can change pretty quickly in terms of geopolitical allies.
Yeah, I totally agree with that.
Well, Alex, in wrapping up the interview, please tell our listeners more about your company and your work. So, if you have a blog website or podcast, and what types of services they can get from you.
Essentially, Anglo Far East has been in business for 23 years now. We were one of the very first allocated custody providers for individuals that was not a bank. So we were one of the pioneers of that entire model. We provide services both to individuals but also to institutions. We have banks, funds, what looks like is going to be mining companies coming on shortly as clients. I was just recently in discussions. We had the Latin Markets Conference here in Panama last week, which we hosted, and I was speaking with the CEO of a mining company that has substantial properties down in Colombia, and his view is very smart in our opinion. He's looking at following kind of the Jim Sinclair model, where he believes that it's smarter to either keep your resources in the ground, or if you're producing, to actually vault them and not sell them off and sit on them and even pay out distributions to shareholders in gold. We think that's a brilliant model, so that we may be starting up a relationship with them here in the near future to do that for them. So we provide both on an institutional basis, whether it's a pension fund, a hedge fund, or any other kind of fund management company that wants to start its own fund in physical gold. We provide those kind of resources. There are many banks who are now interested in gold, but they aren't really what's considered a bullion bank, so we're providing back office and logistical services to them as well. And again, our traditional allocated custody services for just private individuals who want to buy, store, transport, or liquidate gold or silver.
Okay, great. And thank you for your time, Alex, and hopefully we'll have you back on soon to talk more about the physical supply-demand fundamentals.
Thanks a lot, Jason. It was great to be there.